$387 a month. That was the number Ethan heard sitting under bright dealership lights on a rainy Saturday afternoon in Dallas, Texas. And for about 3 seconds, it felt like relief, because the number in his head before walking in was anything under $450. And now a man in a pressed blue shirt was sliding a paper across the desk showing him a payment nearly $70 lower than expected. And Ethan smiled because he thought he had won the negotiation. What he did not realize was that the extra 24 months hidden underneath that payment were about to cost him more than $40,000 over the next decade. Not because he was irresponsible, not because he was lazy, not because he made one catastrophic mistake, but because almost every financial trap in America arrives looking affordable in the moment. And nowhere is that more true than inside a car dealership, where the difference between 48 months and 72 months can quietly separate two people living the exact same life into two completely different financial futures. This is not a story about cars. This is a story about time. Because loans are not really about money. They are about how many years of your future income you are willing to hand away before you even earn it. And on the same Saturday morning, two people are about to make two different decisions about exactly that. You are 25 years old. You make $61,000 a year working in operations for a healthcare logistics company. Your take-home pay after taxes and insurance is about $3,850 a month. You live outside Phoenix, Arizona, in a two-bedroom apartment with a roommate. Your half of the rent is $1,020. Utilities average around $180. Groceries maybe $350. Gas around $140. Your student loan payment is $220. And after subscriptions, insurance, random spending, and life itself, you usually end the month with somewhere between $600 and $900 left over, assuming nothing goes wrong. And this month, something has gone wrong. Your old car, a 2011 Nissan Altima with 172,000 miles, finally gave out on Interstate 17. Smoke from under the hood, engine failure. Mechanic estimate, $4,800. The mechanic didn't even recommend fixing it. So now you need a car. Not eventually, now. Path A. Your name is Ryan, and before you ever step into a dealership, you spend 4 nights researching how financing actually works. Not the fun part, the cars, the structure. You learn that dealerships love stretching loans because longer loans create smaller monthly payments, and smaller monthly payments create emotional permission. You learn that most people negotiate based on what feels manageable per month, instead of what the vehicle actually costs over time. And once you understand that, you stop thinking like a buyer and start thinking like a system builder. You pull your credit score. You go to Desert Financial Credit Union and get pre-approved for 5.8% APR up to $24,000 over 48 months. The loan officer, a woman named Karen, prints the letter and tells you something that stays in your head all week. The shorter the loan, the faster you own your future again. You write that down. You decide your total out-the-door budget is $23,000, including taxes, fees, everything. You walk into the dealership on Saturday afternoon with a number already decided. The salesperson's name is Tyler. Tyler is excellent at reading people. He walks you directly past the base models and toward a gray Honda Accord Sport, black rims, leather seats, a touchscreen big enough to look expensive. Price, $31,400. Tyler asks what monthly payment you're trying to stay around, and you do something most buyers never do. You refuse the question. You say, "I'm focused on total cost, not monthly payment." Tyler pauses for half a second, because that sentence changes the entire game. He pivots. You test drive a certified pre-owned 2022 Toyota Camry SE listed at $22,600. It's clean, reliable, practical, not exciting, exactly what you wanted. You negotiate calmly. You already researched comparable listings within 100 miles. You know the market price. You settle at $21,900 out the door. Then comes the finance office. This is where most people lose, not in the showroom, in the finance office, because the showroom sells the car. The finance office sells the future. A man named Greg sits across from you, with a monitor angled slightly away from your view. Greg offers dealership financing at 8.9% APR. You slide your pre-approval letter across the desk. Greg disappears for 7 minutes and comes back at 6.1%. You decline the extended warranty because you already researched third-party coverage through Endurance for 1/3 the cost. You decline paint protection, nitrogen tires, wheel insurance, and gap coverage through the dealership because your insurance company offers gap for $7 a month added to your policy. Your final loan, $21,900 at 6.1% over 48 months. Monthly payment, $514. Total interest over the life of the loan, approximately $2,850. You sign and drive home. Path B. Your name is Jason, and your week looked different. Your Altima died Tuesday. You spent Wednesday stressed, Thursday borrowing rides, Friday scrolling TikTok car videos, and Saturday morning walking into a dealership wanting the problem solved more than wanting the right structure. The salesperson's name is Amanda. Amanda is warm, confident, efficient. She asks what you want your payment to look like, and you answer honestly. Somewhere around $350, maybe $400 max. From that moment forward, everything in the process reorganizes itself around keeping you emotionally comfortable. Amanda shows you a newer Accord touring trim, heated seats, premium audio, panoramic roof. Price, $32,900. You love it immediately. The interior feels like progress, like adulthood, like success. You test drive it, and before you return to the dealership lot, you already know emotionally that you are buying this car. The finance office begins. Greg is here too. Greg pulls your credit score. The bank approves you at 7.1% APR. Greg presents 10.9%. You never see the original approval rate because dealerships are allowed to mark up financing and keep part of the spread. Greg notices hesitation when you see the monthly payment on a 48-month term, $687. Too high, too uncomfortable. Then Greg says the sentence that changes your next 6 years. What if we stretch it to 72 months? Suddenly, the payment drops to $418. And emotionally, everything relaxes. That is the trap, because your brain does not naturally calculate long-term compounding cost under emotional pressure. It calculates immediate survivability. $418 feels possible. $687 feels dangerous. Greg adds an extended warranty, rolled into the payment. Gap insurance, rolled into the payment. Tire protection, rolled into the payment. Everything disappears into the monthly number. Your total financed amount becomes $36,800 at 10.9% over 72 months. Monthly payment, $418. Total interest over the life of the loan, approximately $11,200. You drive home feeling relieved. Not excited, relieved, because the problem feels solved. And that feeling is exactly what the system is designed to create.